Alright, so this is our financial analysis presentation where we are going through chapter 12 through 15. So now, when companies inform the external world about financial matters through, say, their annual report, stakeholders take this information, analyzes and evaluates it to determine the performance and sustainability of the business itself and other finance-related transactions. So, firstly, it is important to keep in mind that an analysis and an evaluation are not the same thing. The analysis incorporates the examination and interpretation of information. The evaluation, as the name suggests, is the process of evaluating a given development performance, putting the matter differently through an evaluation. One evaluates whether a given development is satisfactory. The level of satisfaction asserted to a development is dependent on whether said development has accomplished the objective that has been identified. The financial analysis can of course be conducted either internally by the company itself or externally by the company stakeholders. An internal financial analysis is however expected since there is more available data and details. The stakeholders that might have an interest in conducting a financial analysis could, for example, be potential bank lenders who seek to assess whether it is willing to lend the business capital. It could also be potential investors who are interested in granting an understanding of the company's stability and profitability. These investors could include venture capitalists. This is when the key ratios become relevant. Namely when analyzing a company's financial development. The financial analysis has its roots in these key ratios. As the name implies, key ratios are numeric values that show the relationship between two or more variables. There are a large amount of key ratios to be calculated and analyzed. Some of them are an overall financial metric that exists to provide a clear overview of a company's general development across various topics. Other key ratios are used as an elaborative tool to describe specific elements of a company. However, the point is that in business, nothing speaks more clearly than numbers. Numbers are the ultimate tool for highlighting elements of a business. Key ratios are most optimally analyzed comparatively. What we mean by this is that determining whether a key ratio is satisfactory by itself can be difficult. As explained above, an evaluation needs a goal or an objective that can be related to. This can, for example, be competitors, wherein one analyzes how well a company is doing with respect to direct competitors. This could also be the industry average. It could also be the company itself, for example, compared to previous years, as we see in this graph, where we have the number of years on the x-axis and the ROI in percent on the y-axis. So it shows that companies can use their numbers themselves to compare them with previous years to see whether the development is going positively or negatively.
The possibilities with the key ratios and the number of key ratios that can be calculated are seemingly endless. However, for these key ratios, for these calculations, and for this analysis to be relevant, the ratios must be valid. In correspondence to this, there are a number of requirements or criteria for the key ratio's validity. And here we have three main requirements for the key ratios. So they are really simple and can sometimes appear self-explanatory. However, they are important to note and they are important to shed some light upon. So the first one is that the key ratios must of course be calculated on the basis of correct data material. This goes without saying that if the data is incorrect, then the key ratios will also be incorrect, and then the analysis will also be incorrect. Now, fortunately, as a stakeholder in Denmark, for that matter, one has the ability to utilize the website called CVR, which we highly recommend, and that website will with absolute certainty not illustrate any data material that is incorrect. The next two things are pretty interrelated. So there must be a logical connection between the numerator and the denominator. And by this we mean that the variables chosen in the denominator and the numerator must show something about what needs to be analyzed. Let's take an example. Especially, for example, for liquidity, one would look into the current assets, for example. And therefore, it needs to be clear that the variables show something about what needs to be analyzed and evaluated. Okay, so far we have gone far as to look at what the financial analysis is. And we're gonna move on to digging into the profitability analysis briefly, but first of all, let's summarize upon what we've been talking about so far. So far we have covered the motivation between both an external and an internal financial analysis. We have covered how the analysis and the evaluation are different from one another, however how they are also interrelated. And we've also understood the importance of key ratios and which criteria or requirements that are for these key ratios. So as a summary upon the financial analysis itself, we can say that the financial analysis is to be conducted in the following way. First of all, the first phase of the financial analysis, so to say, is the collection of material and other relevant information about the company that is subject for analysis and evaluation. The second phase will then be the calculation of these relevant key figures and key ratios. So let's say you're an internal CEO in a company and you would like to expand your company to another country. You're going through an internationalization process. You would of course conduct a feasibility analysis. For this, you must have a base, you must have key ratios, key figures, and all information gathered for this feasibility analysis to be conducted. Now, the next step is then the analysis itself and the assessment itself of the calculated financial ratios. And this calculation and this analysis assessment must all, in the end, provide insight as to which interrelated factors that are impacting the company's financial performance. But generally, the financial analysis is supposed to show something about the financial situation of the company, or in other words, the financial performance of the company. It is also supposed to shed light on the financial development and the financial direction of the company. So, say, is the company growing? Is the company experiencing hard times? Why is it experiencing hard times? Is it because of internal issues, or is it because of, say, there are a lot of other external factors that also influence the company, which is not what we're talking about today, but you have, for example, the interest rates, you have the economic cycle, and so forth. So getting an understanding of the financial development of the company, the internal financial development. Now, it is also, of course, then it goes to say that the economic rate of development of the company will then also be understood, and then inevitably the financial relations in the company. So the financial analysis can therefore be the ground for potential suggestions for the company. So whether you are the owner of a company, if you are working in strategy, if you're doing anything internally or externally for that matter, if you would like to propose future initiatives for a company, if you would like to come with suggestions for the company, you must have some kind of base. And this is where the financial analysis is incredibly useful. Conducting such an analysis grants insight as to what needs improvement and where the company is strong. And as you might be able to hear, this is also what we know from the SWOT analysis, the strengths and weaknesses. So it grants a thorough understanding of the financial relations inside of the company that can contribute to recommendations for future initiatives, feasibility analysis.
Now that we have talked about the financial analysis in general terms, we can dig into the specifics of it, where we find a prominent topic, which is the profitability analysis. So, what exactly is a profitability analysis? In simple terms, a profitability analysis deals with an enterprise's ability to generate a profit or a return on the capital invested. So now the question begs, how does one analyze a firm's profitability? Well, profitability is generally regarded as being influenced by two distinct factors, namely the earnings capacity and the capital adjustments capacity, which we will dig into deeper in the coming slides. So, the earnings capacity, what is it? This aspect of the profitability has to do with the company's ability to actually generate a profit based upon the revenue. Notice that I said profit. So, as we know, the profit is the difference between the amount earned and the amount spent, or in other words, when costs have been deducted. Therefore, the analysis of a company's earnings capacity deals with the relationship between a firm's income and its costs. Now, as we know, costs are not universal. This means that there are different classifications for costs, and people often talk about variable costs and capacity costs, which together make up the operating costs. Distinguishing between different types of costs grants the analyst the ability to assess and understand how each type of cost has influenced the earnings capacity. So, as is seen in the picture, the left side of the Dupont model, or the Dupont model, illustrates this in an understandable manner. Here, we can see that, of course, the analysis of earnings capacity commences with the net turnover. Therefore, the variable costs are deducted, and that reveals the contribution margin. The contribution margin indicates the available capacity the company has at its disposal to cover the capacity costs or the fixed costs. By dividing the contribution margin with the net revenue, we get our very first ratio, namely the contribution ratio. And the contribution ratio shows the relationship between the contribution margin and the revenue.
Alright, so this is an example of how the contribution ratio can be used to analyze unnatural, natural, satisfactory, and dissatisfactory developments in a company. So, as we know, an increase in the variable costs is often inevitable when there is an organic increase in revenue, because the variable costs are directly linked to the sales volume, and therefore an increase in the variable costs is not inherently an example of inefficiency within the company. However, this is where it gets really interesting, since the contribution ratio shows the contribution margin relative to the revenue. A decrease in the contribution ratio itself is not a subsequent effect of an increase in revenue. An unnatural increase in the contribution ratio could rationally reflect the company's inefficient ability to manage their variable costs. Perhaps the company is unable to keep up with costs in times of growth, or other prevalent factors may be influencing this. However, what I mean by an unnatural development in the contribution ratio is that for most companies, in most cases, an increase of say 1 to 2% or a decrease of 1 to 2% has nothing to do with increased effort to enhance financial matters. It's often just something that happens completely naturally, since you don't have the same sales all the time, all years. However, this really goes to show how the contribution margin can reflect inefficiency and efficiency within a company. However, a logical question when using the contribution ratio to evaluate a company's ability to manage their variable costs and to create activity, and to manage their costs and create profitability, is when is it considered a good ratio? What is a good contribution ratio? Now this, of course, differs from industry to industry, and it differs further from company to company. And you're going to hear us say this a lot in this presentation, and that is because it is true. There is no one metric that's perfect and that all should have that one metric, because industries are different, companies are different. All companies operate under different, company ethics, and all industries have different standards. However, some industries, like the retail industry, would inherently have higher variable costs than the financial industry, therefore have a higher contribution ratio. A company's contribution ratio should therefore not be compared with, any random company. For that matter, no company should be compared with a random company. But this just goes to show that companies always should be compared with direct competitors within the same industry. The following type of costs are the capacity costs, or colloquially referred to as fixed costs. When these are subtracted from the contribution ratio, we have the profit before interest, as you can see here in the picture. It is also commonly referred to as EBIT, which is an acronym, or actually it's an abbreviation for earnings before interest and taxes. So similarly, when dividing the profit margin, the net profit margin, with the revenue, one gets another key ratio, which is the net profit ratio. The net profit ratio is a key ratio, and it measures the percentage of all revenue which translates into earnings once all the operating costs have been covered, which is to say that it excludes the taxes and interest, which the company is often not in control in. Hence why some people like to call this the operating margin or the operating ratio. If the profit margin ratio is 20%, for example, this means that 80% of the company's revenue has gone to cover the company's operational costs.
So here it is seen that the revenue from year 1 to year 2 has increased by 30%, and that the operational costs, which is the sum of the capacity costs and the variable costs, they have increased by 34%. And the profit margin, or the profit before financial costs, has subsequently increased by 18%. The increase in revenue and profit might seem very positive and satisfactory on the surface. However, when calculating the net profit ratio, we become aware that it has actually decreased. The reason for that is that the costs have decreased at a higher rate than the revenue. In fact, they have decreased at a higher rate of approximately 4% more than the revenue, as it is seen on this table. So numerically, more profit for the year was left for the equity. However, the profit, when seen proportional to the revenue, have decreased, meaning that a lower amount of the revenue was actually turned into profit, despite of the profit having increased in this period. The opposite situation can also happen, however, there is not enough time to illustrate that. Now, it's conclusions and interpretations like these that are what makes the net profit ratio such an interesting and important key ratio. So to conclude all of this, analyzing a company's earnings capacity using key ratios such as the contribution ratio and the net profit ratio reveals a great deal about the relationship between earnings and costs. Therefore, it allows the evaluations of a company's current financial situation and development, and can easily be compared to the industry or competitors. As an example, a proper conducted analysis of earnings capacity can reveal how effective companies are at minimizing their costs. Now, moving on to the next slide. So, as we mentioned previously, the profitability analysis deals with the two main factors, and the first one being the earnings capacity, which is the one we just went through and have analyzed, where we covered different key ratios that compared the earnings with the costs, or to the costs. Now, the second part of the financial analysis, or the second part of the profitability analysis, deals with the company's abilities to generate activity, or in other words, to generate revenue based on the invested capital, which is the company's assets. This part is known as the capital adjustments capacity.
So for the capital adjustments capacity analysis, we are looking at profitability from the perspective of the top line instead of the bottom line, as we were with the earnings capacity. We're looking at the relationship between the company's assets and the revenue. Hence, it is largely concerned with maximizing revenue rather than, say, minimizing or managing costs as the earnings capacity. Moreover, the data that is used for analyzing the capital adjustments capacity is partially found in the balance sheet rather. Now, similar to the earnings capacity, the DuPont model includes the elements from the capital adjustments capacity. These are the right side of the model, as you can see here. It all starts with getting hold of the company's total assets, which are merely the fixed assets and the current assets added together. Thereby, it is divided with the net turnover, and from there we get the key ratio, that is the asset turnover ratio, or short for ATR. So this ratio is measured in times and not in percentages, which is crucial to remember. We have a small picture at the right side of the PowerPoint presentation where you can clearly see the relationship. So here we have revenue of 2,000 and assets of value of 1,000, and therefore the asset turnover ratio is 2 times, since the assets have been doubled in terms of how much revenue or how much activity has been created. Now this ratio can help analysts comprehend changes in revenue or changes in assets and what effects this will have on the company's profitability. First of all, if both the revenue and the assets increase at the exact same rate, theoretically, the asset turnover remains completely stationary. Thereby, an increase in revenue is not always an indication of an increased adaptability or an increased efficiency. Likewise, an increase in assets does not necessarily indicate a decrease in turnover efficiency. So changes in the asset turnover ratio can be understood by the change in revenue in percent relative to the change in the value of assets, also in percent. An increase in the asset turnover ratio can happen if the revenue increased relatively more in percent than the assets. In other words, if the revenue increased at a higher rate than the assets. The ATR could also increase if the assets decreased at a higher rate than the revenue. Conversely, an increase in assets at a higher rate than the revenue causes a decrease in the ATR. So this really helps to shape our understanding about the asset turnover ratio.
So, a logical question when using the asset turnover ratio to evaluate a company's ability to generate revenue from their assets is: when is the ratio considered a good asset turnover ratio? Now, as with previous ratios that we mentioned earlier, this differs from industry to industry, and it also differs from company to company. So to illustrate this further, we have chosen to compare two different industries, namely the retail industry and the gaming industry. Looking at an industry like the retail industry, they would have a higher asset turnover ratio than the gaming industry because retailers need a physical platform in the form of, for example, store space to offer their products, like as a place to store their inventory, which increases their assets values. Whereas a company within the gaming industry does not need such a platform to offer their products since it is available digitally. Therefore, the average company within the retail industry or the average company within the gaming industry would have a lower asset turnover ratio compared to the average company within the retail industry. A company's asset turnover ratio should therefore not be compared with any random company from any industry like with the other ratios that we mentioned earlier, but it should rather be compared to other companies within the same industry. The next ratio that we will focus on is the return on investment, which is a financial profitability metric. Now, a financial profitability metric is a metric or a ratio that shows the relationship between different ratios. In the case of the return on investment, it shows the relationship between two different ratios, namely the profit margin ratio and the asset turnover ratio. Now, the following picture explains this more in depth, where we have also included some math. So, the return on investment is usually calculated saying profit before financial costs times 100 and divided by assets. Now we can change this by multiplying the net revenue in both the numerator and denominator, which this means that it will eventually actually stay the same. It will give us the same result, but we have done this step in order to show that it actually shows the relationship between two different ratios. So we'll end up with the following fraction: profit before financial costs times 100 times the net revenue divided by the net revenue times the assets. Now this fraction can be divided into two new fractions, where we have the profit before financial costs times 100 divided by the net revenue as one fraction, and then this multiplied with the net revenue over the assets. Now, When looking at this, it's clear that these two fractions are the formulas for the profit margin ratio and the asset turnover ratio. And therefore, the return on investment is merely the product of the profit margin ratio and the asset turnover ratio. Now, the ROI indicates the overall performance and sustainability in the long term and the short term. It reveals the company's capital adjustment capacity in terms of the asset turnover ratio and the company's earnings capacity in terms of the net profit ratio or the profit margin ratio, which is the same thing. Now, it's for this reason that the return on investment is such an amazing ratio and an important one as well that is widely used for analysis. The return on investment can increase from either an increase in the net profit ratio or the asset turnover ratio, and the other way around. A decrease in the net profit ratio or the asset turnover ratio will result in a decrease in the return on investment. And that is because since they are both variables that are multiplicators, meaning that they of course both influence it.
So it is evident how the return on investment shows the company's ability to generate a return on the invested capital and the company's ability to generate a profit based on their earnings, regardless of whether this is financed through equity or through loans. So that is important to note. So in order to get a proper hold of the company's debt situation, one should look into the gearing ratio and the cost of debt ratio. First of all, we're going to look at these two ratios, and thereafter we're going to look at the return on equity, which is used to analyze the company's equity situation. But since risk is a huge factor when discussing finance, the capital invested in the company's assets could just as well have been deposited in a bank or used to buy bonds. These alternatives would have resulted in a safe return in the form of interest income, and thus a lower risk than investing in a company. This is where we start to talk about the market rate of interest. So the market rate of interest is, well, the interest rate which can be obtained by investing in bonds. And in 2017, as an example, the market rate of interest was at about 2 to 3%. So with the fact that investing in a company is associated with a very high risk being taken into account, one can measure the difference between the return on investment and the market rate of interest. Whether the return on investment exceeds the market rate of interest thus helps the evaluation of the company's financial position. As we've mentioned a couple of times before in this presentation, evaluating a company's profitability situation, financial situation, solely based upon the key ratios by themselves seldom gives any adequate result, any fruitful analysis points. Therefore, we take these ratios and we compare them to each other. We compare them to external matters. We compare them to other companies. We compare them to the industry. One of the things that you can compare the return on investment to is the market rate of interest. So if the difference between the two is positive, we say that the company has accommodated a satisfactory risk premium, and it can be rationally concluded that investing in the company should yield more return than investing in a bank or government bonds, and vice versa. If the relationship is negative, then it would have been a better financial decision to invest in banks and bonds. The difference between the two should always be positive in order for the company's financial position or situation to be deemed satisfactory. What one also can do when looking at debt, and often you would ask yourself, well, it is not always negative that a company utilizes debt, because we know from refinancing and from all of these different elements of business that companies as well as private individuals can actually make money off of working with debt. So how do you mathematically calculate whether the company is making money off of working with debt? Well, This is by looking at the difference between the return on investment and the cost of debt ratio, where one can measure whether the company is profiting from using debt. In other words, if the company is making money from working with debt. The cost of debt ratio is found by dividing the financial costs by the liabilities and thus shows the average interest paid by the company for its debt. Measuring the difference reveals the interest margin, and this is another margin that is crucial. If the cost of debt ratio is lower than the return on investment, it will equal a positive interest margin, and thereby the company does indeed profit off of working with debt. If it is negative, then no, the company does not. If there is a positive interest margin, then the return on equity will be higher than the return on investment. However, why is that, and how does that make sense?
The reason for that we will explain by analyzing the two key ratios, return on equity and the gearing ratio. So the return on equity shows the return on the invested capital made by the company owners. And the formula for calculating the return on equity is therefore profit before tax times 100 divided by the equity. Now, the formula uses profit before tax because the profit before tax, or the profit after financial costs, goes into the equity, where the financial cost goes towards the debt. Now we'll find out that the ROE can be calculated in another way, which is the result of the equity merely being a measure of the ROI, but where the result of the ROE can decrease or increase depending on whether the cost of debt ratio is lower than the return on investment or higher than the return on investment.
Indeed. The following formula is also one that is viable for calculating the return on equity. The formula is as follows, as you can see on the screen. The return on equity will be equal to the return on investment plus, parentheses open, the return on investment minus the cost of debt ratio, parentheses closed, multiplied by the gearing. So what we have here in the middle is the interest margin. Now, as it is seen, the formula is partially based on the return on investment. However, since the return on equity is merely a measure of the return on equity, leaving profit from liabilities out, the cost of debt is subtracted from the return on investment and it is then multiplied with the gearing ratio in order to cancel those two from the calculation of the return on investment. In order to understand why exactly, the gearing ratio must be explained. So, the gearing ratio is used to measure the ratio of debt to equity. In other words, it is a measure of how much debt a firm has compared to its equity. As a rule of thumb, the ratio, and this is like a very general rule of thumb as we've emphasized before, it varies, but it should be between 25 and 50%. But of course, yeah, this depends on the cost of debt ratio compared to return on investment, which, as mentioned earlier, tells us something about how a company utilizes its debt and turns it into profit compared to the cost of debt. Hence, it highlights the relationship between the return on investment, the cost of debt ratio, and the gearing. Now that we have acquired a thorough understanding of the gearing ratio, the cost of debt ratio, the return on investment, and the return on equity and their relationship to each other, it just with a bit of mathematical rationale sparkled on top of this, we can immediately understand how a positive difference between the return on investment and the cost of debt ratio, which is the interest margin, and it is the variable that is inside the parentheses. If that is the case, then the return on equity will of course be larger than the return on investment, since the return on equity is the result of the entire this entire formula here. If on the other side the result was negative, it would have been multiplied with the gearing ratio and added with the return on investment, and the opposite would then have been the case. This formula can be pretty difficult to get a hold of in the beginning. However, it will always be the same as the return on equity being equal to profit before tax times 100 divided by equity. What is special about this, and the reason we included it in our presentation, is that it really gives a good understanding of how everything is interrelated. on a whole other level, and how these key ratios do not stand alone in any particular instance. This has been our presentation about the financial analysis. What is it? Why do you conduct it? How do you conduct it? What is included? What can you use it for? What is profitability? What is earnings capacity? What is capital adjustments capacity? And so forth. Please feel free to watch the video again if you would like to learn more about this. Thank you so much for watching our video.